Thank you, and welcome also from my side. Glad to be here, glad not to speak about football, better speak about proper risk and return, because when pick a random football game from last Tuesday and a team that's up 4-0 after 60 minutes, so has good execution. On the other hand, if you draw in the end, some poor risk management, so perhaps speak about proper risk management here. So interesting to see, 54% of you say he would still have received the Nobel Prize, so it's about 50-50. My answer would be similar, saying yes, he deserved a lot of credit, because he is one of the pioneers in modern portfolio theory. On the other hand, one of his key claims was that he said you cannot really achieve higher returns without accepting a certain level of risk. So reducing risk is automatically accompanied by having lower returns. So I'd like to share with you now research we did. And what you see on this slide is a universe of over 3,000 stocks that we analyzed and that we grouped by volatility. And you see the decile number 1 on the very left, 10% of stocks with the lowest volatility. And what the chart shows is the average outperformance, underperformance over the universe average. Good to see here that the lowest volatility stocks generate market-like returns. They even outperform modestly. What you also see, and this is what Markowitz would not have anticipated, that you don't get a risk premium. In other words, if you increase the risk level in your portfolio, here on average you get even lower returns. So in other words, what you say, the market ignores the boring low volatility stocks. On the other hand, pays high premiums for the highest volatility stocks. These are more or less lottery tickets. If you're right, you can make a big profit, but chances are high that you lose on it. So the one point, risk management is obviously very important. And what I'd like to show you here is one of the key trends that we've seen over the last years, minimum variance-oriented portfolios. In other words, you minimize the risk from equity investing by investing in the lowest possible volatility portfolios. What you see on this chart is a universe of investment opportunities. The gray dots, the blue dots show where would be a risk-minimized portfolio be invested. And you see on the vertical axis the fundamental attractiveness that we plotted here as well. So minimizing portfolio risk would result in a portfolio that is, as it says, risk minimized, but it's not really return oriented. You would pick fundamentally unattractive stocks in a minimum variance portfolio. So portfolio management is not that easy. Just plug in some risk numbers. So what I'd like to share with you is our approach, how we actively manage these portfolios. So I'd like to share with you the lobster theory. So why a lobster? Because it is a very complex matter. You have a lot of legs you need to consider. Some are more important, like the claws of the lobster, but there are also secondary considerations you need to keep in mind. And still looks a bit like a lobster, not as nice. But you see the claws I'm talking about. It's risk on the one hand, but it's also return. So you want to invest in fundamentally attractive stocks for the risk you're taking. Plus, this is the legs that the lobster has as well, secondary objectives. You will also want to look at market liquidity. When you invest in a passive minimum variance portfolio and you do back tests, there's some nice stocks that pop up that looks extremely stable even in down markets. This is what we did, for example. And when you look at them in more detail, you see they're very stable because they're not traded at all. So you really look for what is implementable, what can you really trade, and what is in real life a viable solution. Plus, you also want to look at diversification parameters in the sense that you do not want to put all eggs in one basket. You want to make sure that you have a broadly diversified portfolio that is not too much focused on utilities and telcos and the likes that is too defensive, and when the market rises, you're out of the market, basically. So it's a more complex matter, and you want to really analyze a portfolio based on the best risk and return parameters. So let me show what a result you get when you do this kind of analysis. This is a portfolio that is trying not to minimize portfolio risk, but it wants to invest in below average volatility equities that are fundamentally attractive. So you see it's still tilted towards the left, the blue dots. We're still invested in below average volatile stocks, but we selectively take higher risk opportunities if we feel that the risk you're taking is being paid for, and it diversifies as well. So really the key approach needs to be active, have a return forecast in your risk control, so to benefit from such an approach. And this chart shows nicely what a combination of volatility control and fundamental attractiveness analysis can generate for you. This chart shows you on the bottom part monthly index returns, and these are live numbers net of fees for retail shares. So this is what the retail investor could have bought. And you see on the top part of the chart active returns that can be generated with such a strategy. To the very left, you see bear market environments, markets under stress, where the market is down significantly. In these market environments, you can significantly reduce drawdowns through strong risk management and an alpha from stock selection. In a normal market environment that fluctuates 3% up and down per month, I should say, nowadays it's a daily movement, you still have this alpha potential. So risk management is not a key consideration here. You have alpha potential from fundamental attractiveness where you can benefit from. And not surprisingly, in a strongly rising market, having a volatility control mechanism reduces or caps your upward potential to some extent. So in other words, you will not participate to the final basis point if the market rallies, if high risk, high beta is in demand. Over a full business cycle that has a combination of these various market scenarios and events, you have a very good outperformance potential, keeping in mind that you still have this risk management. You save on your risk budget, you more effectively and efficiently use available risk budgets. So in other words, relative to a passive relative to an ETF investment, when you invest in the equity market, you can take higher allocations in such a low vol strategy with the same risk budget you're using, or alternatively, take a same allocation of such a low vol strategy relative to an ETF alternative and save some of your risk budget for other investment alternatives. So in times when it's very difficult to generate performance, when you have very tight risk budgets, you really need to control your risk very, very good and make sure that you get the most out of it. And with that, I'd like to conclude my short presentation and invite you for questions, if you like.
We have 1 minute, so...
So take the first 10 questions.
Be quick.
All right. If there are no questions at this stage, I will be around for the afternoon. It's meant to be a short and a brief presentation for you to get some insights what we at Invesco are thinking about at the moment. I invite you to speak about it over a coffee, and thank you for your interest in the presentation.
Thank you.